We didn't take 20 years to build an empire. It compounded over 20 years, but we took strategic actions during a short period of time that really made all the difference in the world. And I share this because it's important. We didn't build our wealth by hustling nonstop. We didn't flip hundreds of homes. We didn't scale an empire overnight. We didn't overcomplicate strategies. We were pretty darn simple. Hi, I'm Jonna. I'm a real estate investor, entrepreneur, and mom who built long-term wealth through real estate, all while my husband and I balance full careers and family life. If you're earning a good income, saving for retirement, and doing all the right things, but still feel like your money isn't creating the freedom or security you want, and you want a great life, you're in the right place. Let's get started. Hey friends, welcome to Real Estate Investing for Life. I'm Jonna. So glad that you're here. If it's your first time here, I want to especially welcome you. And I want to invite you, after you listen to this episode, listen to the last few, because this is part 4 and a final part in a little series we did about identifying what type of investor personality you have and what type is right for you based on your goals, okay? And today is my favorite. So spoiler alert, we're going to delve into passive real estate investing and why it's the strategy that I believe in so strongly. This path is so powerful because a high income earner can earn an extra 7-figure wealth, often from just 1 or 2 strategic moves that compound over time. It's just one of our types of investing. Over the last few weeks, we covered active investing for cash flow, and the FIRE movement, financial independence, retirement early, which is very exciting. But passive investing and long-term investing is really for someone that wants long-term legacy and stability for their family. This path supports your life, but it doesn't take over your life. And why would high-income earners or successful people choose passive investing? Well, if you're successful in life, you're probably not too short on day-to-day money and having that monthly income come in, but you are short on time. And here's why passive investing may fit your world so well. The first thing is you don't have room for another job, right? Flipping, wholesaling, managing contractors, they just don't fit into your schedule. And passive investing requires decisions or leadership, if you will, and not daily involvement. Part number 2, why it might be a thing that you'll choose, is you earn great money, but you need a long-term plan. Many high-income earners accumulate cash, but they aren't building true sustainable wealth. And real estate that's passive can fill that gap. You want the tax advantages. That is a really important thing that high-income earners should consider too. Depreciation, cost segregation, long-term capital gains, and 1031 exchanges can save tens of thousands over time. Now, I know I just said a lot there, and that is a whole different subject that I can do some training on, but there are definitely tax advantages if you're strategic and you're working side by side with your tax professional to make sure that you're taking advantage of them. Point number 4, why busy, successful folks may want to choose passive investing is because you want lower risk and professional management. Passive investments leverage great operators, stable markets, and experienced teams. Number 5, you want to build wealth quietly and in the background. Your life doesn't need chaos. Passive investing allows your wealth to grow while continuing to live your life. So delving into my personal strategy and history a little bit, we didn't take 20 years to build an empire. It compounded over 20 years, but we took strategic actions during a short period of time that really made all the difference in the world. And I share this because it's important. We didn't build our wealth by hustling nonstop. We didn't flip hundreds of homes. We didn't scale an empire overnight. We simply had 3 strategic years where we made 1, smart purchases, 2, simple long-term decisions. We didn't overcomplicate strategies. We were pretty darn simple. We didn't take unnecessary risks, and we didn't do real estate just to give us something to do. We were very, very intentional. And then we held on to those assets. And a decade later, those few moves compounded into significant net worth. And again, it's not because we work endlessly, but because passive strategies reward time, consistency, and long term thinking. And that's why I believe with absolute conviction that one well timed passive investment can add seven figures to your net worth. Not hype, not magic, just math and patience and leverage and appreciation and tax advantages. So, Jonna, you might ask, how can one strategic passive move build seven figures? Well, here's how it happens. The first part is appreciation. It's amazing how even 3 to 4% annual average appreciation compounds dramatically. A $450,000 property can easily become $900,000 or more over 20 years. Number two, there's the principal pay down. Your tenants pay down your loan. They pay off your loan for you, and that can add $300,000 to $600,000 to your net worth quietly. It's a beautiful thing. Three, cash flow. Even small cash flow adds up, and that can be reinvested. And keep in mind, at some point, you'll have that property paid off, in which case you truly will have cash flow no matter what the interest rate is that you have on it currently. Number four, there's a tax savings. Depreciation alone can save tens of thousands in taxes. And number five, compound growth. There's rental increases, appreciation, and a loan pay down, and combined, that really adds up. And number six, you can take advantage of portfolio snowballing. So you can refinance, 1031 exchange, or use a HELOC to grow your portfolio. You can put these together and it becomes obvious that one passive investment held long enough can realistically become a seven-figure wealth creator. So powerful, guys. And if you don't believe me that one property can easily turn into seven figures of net worth after the power of time, I've got a couple of stories for you. I will keep them short, but the first one is a property that we purchased in 2007, which at the time was the height of the market. And then I think it was August, and then 2008, actually the month after we purchased, September of 2007, the market started to tank. So that was fun. But it was a property that we had purchased to move into for a year, and then our intent was to turn it into a rental property. So we bought it at the height of the market, moved into it, and I'm telling you, at one time during the Great Recession, it was half its value. So that was not very much fun. But we ultimately moved out of that property and put tenants in it. And today we have owned it from 2007, 18 years, which I cannot even believe. That property, we did a 15-year loan, so we actually have it paid off. And believe me, that house is cash flowing to this day. So we kept it as a rental property when we moved out, and now we've been able to pull cash out of it and utilize it for various investments, and it's the house that keeps on giving. Here's a quick example of how you can make a quick decision between purchasing a rental property and purchasing something that is not truly an asset, but just something for your lifestyle, and how it can form the difference. I have one property that we purchased in 2007, which was the height of the market at the time. I think we purchased in August of 2007, and the market started to tank in September of 2007. Isn't that fun? There was a period of time where it went way, way down, but you better believe me, that property is up to this day, 18 years later. And so we purchased a property for $233,000. We put very little money down into it because we purchased it as our primary home when we first came into it. So our intent was to live in for a year and then turn it into a rental property. So for those situations, you can get in for as little as 3.5% down on a home, put very little money into it, lived in it for a number of years, moved out, did a 15-year mortgage. So that property is paid off now, but that tenant is not only paying the taxes and insurance, they are paying true cash flow every month to our entity for that property. So over time, between the depreciation, the money we've taken out to take out of that home to use for other projects, to just the sheer appreciation, and then the cash flow and the rental income that's come in, it's a seven-figure property today for a property that we paid $233,000 for in 2007. And the beauty is because it's paid off, that cash flow comes in perpetuity and the rent keeps going up. So I'm going to contrast that with if we would have in 2007 take that little down payment and put a lot more money into purchasing a luxury SUV in August of 2007. I could look up Kelley Blue Book, but I would guess that car today is probably worth a couple $1,000s that would no longer be in our family and no longer be creating a legacy, let alone. And so the juxtaposition between making those decisions with just one or two strategic real estate purchases is absolutely a game changer. And that's part of the reason that I'm such a believer in the power of passively investing in real estate for the long term. Hey friends, are you struggling to figure out what type of investing path is right for you and what fits your personality type? Fun news, I've got a quiz set up just for this purpose. Take 60 seconds and head over to jonnaweber.com/investor quiz. Fill out your profile and we'll figure out what type of investing is right for you. So let's take a look at a couple of the passive wealth building strategies that are really popular for people that are looking to build wealth passively. The first one is pretty much what I just described, purchasing long-term rentals. And that can be, of course, a single family or even small multifamily, but it is something in which you typically would have a property manager. And if you want to self-manage, you may be what's called a hybrid investor and a little bit of both. And that really has been my story over the years. But if I were to go back and do it over, I might have property manager in place since the beginning so that I could have freed up my time to make more money elsewhere. But that's a whole different podcast. So there's long-term rentals, of course. Another popular thing for those that are passively investing in real estate are investing in what's called real estate syndications. You invest in larger properties, whether that's multifamily, storage, real estate development, build to rent. There's all kinds of opportunities for real estate syndications, and you'll receive distributions plus potential appreciation. Appreciation's never guaranteed, but it's always a potential. So in that case, you're really a partner. You can have real estate holdings or participation in real estate holdings, but you're not a landlord. The third way that a lot of people have success in that passive real estate investing is real estate funds. And that is something that you go to someone who has a diversified fund, maybe a debt fund. It's professionally managed and it's accessible. So this also is great for investors wanting built-in simplicity with built-in risk protection. Another thing that a lot of people consider if they're doing the long-term wealth strategy is starting in private lending. Again, a lot of people that invest in the passive wealth building, they have a lot of immediate cash flow or maybe money sitting in a stock market or a savings account or a self-directed IRA they could use to create real estate investing equity. And they get into private lending, which is really a fascinating and very successful way that a lot of people can continue compounding their wealth. So how it works is you lend money to trusted operators and you earn interest. That's all there is to it, really. There's no ownership, no tenants, just predictable returns. Although you do put liens on the property if you're helping them, like say they're fix and flipping and they're building in addition to a house and doing all the things, you want an interest in that property. Whole long subject that we can go into, but private lending is something that you may want to consider. And so you've got your long-term buy and hold investing, whether it's in a single family, small multifamily, possibly commercial. There's pros and cons to all these things. There's real estate syndications, there's real estate funds, and there's private lending. And these are all really great opportunities in their own right with different pros and cons. Let's talk about some of the myths and mistakes that passive investors make. The myth number one I thought about is that passive returns are always lower. So People get all caught up with like how sexy like flipping a house is and the great returns that they get at it a very short time. I made 50,000 on this house. But once you factor in the time factor, which is our most precious commodity, plus taxes and risk, the passive often wins. And guess what? Those $50,000 returns, they're not guaranteed either, which I know you know that, but especially if you're just getting started and if you're working a full-time job, they're especially not guaranteed. I promise you. There are exceptions out there, but it's very few and far between. And another myth is that you've missed the best time to invest. And I hear this all the time because our market is higher, our interest rates are higher. It's not easy like it was. Rents have softened. There's all the different excuses or reasons why we can't invest in real estate at that time. Remember I talked about my 2007 purchase? Like I said, that was at the height of the market. And then it went down, down, down it took, I think, 6 or 7 years after it went down to get back to the value which we had paid for it, which that was not fun. But when you held a long-standing asset in a great location and something that's always going to be valued in some way, eventually it will go up. It's just the law of real estate as far as there's ups and downs. And if you hold on to it long enough between inflation and appreciation, you're going to be okay. As long as you have a tenant in place that can pay those bills, I just advise most people just to hold on because it does get better and not to sell in a panic. Okay. Another mistake that I see passive investors make is stop being passive and they chase shiny objects. And I own a real estate investor network with hundreds of investors in it. And even for passive investors like myself, it's hard not to get swept away by all the newest methods. And we call them shiny objects in the business. And I want you to get involved in these networks and learn all of the different things. And you can take away little key takeaways from the way everybody is doing things, but stop chasing shiny objects. If you're clear on your objectives, what you're hoping to achieve from your real estate investments, and you have the end in mind, you need to put blinders on and keep at what you're doing and just evaluate that closely and make sure that what you're doing is working. And I think they say mind your own store first, right? So I see it all the time that passive investors, they stop investing or they don't take action because they're too busy chasing shiny objects. The next mistake I see people make is thinking short term. Passive wealth is created over decades, not months. And so it can be very frustrating when you own a property and all of a sudden there's a blip in the market and maybe a COVID event happens or mortgage interest rates just pop up like crazy and spiked like they have the last few years. Yes, it may be something where it is temporarily a little bit down in value, but passive wealth is created in decades, not months. And it's so important to remember that. So who is passive wealth building for? I just want to reiterate who it's ideal for. It's ideal for you if you're a high income earner, you want more wealth without putting more work on your plate, you want tax strategy, you want reliable and long-term stability, you want a simple way to reach financial independence, and you value passive growth over active hustle. And most people that want these things fall into the category of passive wealth builder. And it's incredibly common and incredibly effective for professionals, entrepreneurs, and executives. And a couple of tips for how to get started. The first thing you're going to want to do is to clarify your long-term goal, whether it's retirement, tax savings, wealth transfer to your next generation. Choose your level of passivity. Do you want ownership? Do you want to participate in a syndication? Do you like the idea of private lending? Do you want to invest in your local market or do you want to invest out of state? You need to pick your market and then you need to set your criteria, your return expectations, your hold time, your risk preference. Let's say you're looking to invest in a syndication. You need all of that lined out so that you have your buy box in mind, what you're going to participate in, because otherwise emotion can get taken over and you can get swept into something that you didn't intend to get swept into without really thinking things through. Definitely have your return expectations, your hold time, and your risk preference set out ahead of time. And then I think you're ready to make your first strategic move. And your 3-year window that makes all the difference in your success later on in life related to your net worth, it could start today. So friends, if this episode resonated with you, you may be a passive wealth builder at heart. And if you haven't taken the Wealth Type quiz yet, it tells you exactly where you fit in. If you want help with any of this, information is available on my website, jonnaweber.com, and your strategic season could begin right now. Thanks for listening. Until next time, keep going, go and grow, and we'll catch you on the next episode.